Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Chargepoint continues to be one of the hotter names in electric vehicles and charging, but I think there are some massive red flags for the company that investors need to think about before buying the stock. In fact, this is a stock that I would avoid altogether, and I want to get into those red flags and why. That's my opinion on the stock. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you're interested in more on disruptive companies, check out my newsletter, Asymmetric Investing, in the show notes. The first thing I wanted to talk about is the recent news that Tesla's North American charging standard has basically won the electric vehicle battle. So this is going to be the standard that most vehicles in North America are going to include. That means that both chargers and vehicles are going to need to be on that standard. It's not surprising that we heard shortly after some of the bigger announcements that Chargepoint is going to support the North American charging standard, this NACS standard right here. If vehicles are moving to that standard, then the charger is going to need to move there as well. But what happens when Chargepoint makes that decision? Blink Charging does something very similar. EVgo does something very similar, announcing that they're supporting the NACS standards. The problem with charging companies is that they're not doing anything that isn't completely commoditized. The electricity that's going into vehicles is a commodity. The plug that's plugging into vehicles is standard. It's a commodity. There's no real value add for a Chargepoint charger versus any other charger. And now you're competing with Tesla's superchargers as well. So typically when you have a commodity product like this, the margins just get squeezed out of the business. That's what I think is going to end up happening with Chargepoint. And we can already see evidence of that right here with the company's cash from operations. Cash from operations over the last 3 years has just dropped like a rock, now negative $300 million on an annualized basis. That is simply not sustainable, and it's not really justifiable given the fact that Chargepoint is selling a lot of its chargers. It should be able to make money on those sales. It should even be able to be profitable on the charging network that it owns itself, because it's depreciating those assets and selling electricity. That should be a profitable business from the moment those chargers are built. So that is not a great sign for the company's operations. That negative cash flow is a major red flag for any business, even in a growth market, especially when you don't have some sort of differentiation in the market. To add to that, my third red flag is Chargepoint's balance sheet and stock dilution. You can see right here a chart of Chargepoint's total long-term debt. That's the orange line. And then shares outstanding, that's the purple line. So you can see that even over the past 2 years, Chargepoint's shares outstanding have steadily increased. The two ways to fund operations, if you're losing money on operations, is to raise money through debt or sell stock. Chargepoint has been doing both of those things over the last 5 years. This is a red flag because it shows that the company needs to raise money and it's willing to do anything that it can, even dilute shareholders to do that. And that's because it's not running a profitable business. And if you look at that debt on the balance sheet, that's debt that the company needs to eventually generate a profit to pay off. And we're not seeing that with operations right now. So Chargepoint is in a really difficult position because it has a commodity product and a commodity plug in a commodity market, and it's losing money. These are massive red flags for investors. Just simply a stock that I would stay away from right now. In fact, the entire EV charging space is, I think, an area that investors should stay away from because it's highly capital intensive and has not proven to be something that you can generate returns from. But do you disagree? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.